And at the end, if you look at the whole 52-year period, the S&P category, all equities, 3.7 million in value versus almost 6 million in value. Little things mean so much. And then there's the distributions. We have over 100 tables devoted to looking at different ways to distribute money. I know it's overkill, but we're trying to make sure we have information that will help as many investors as we can. Fixed means you start with an amount of money. Let's say on $1 million, you start with 40,000. You take that out. There's that old 4%, and then you adjust for inflation each year. Flexible means that you totally ignore inflation. You just take out 4% a year or 5% a year. That's what my wife and I do. We ignore inflation because we oversave. We don't have to worry about inflation. That, I think, is one of the greatest financial luxuries we have, is to have oversaved when we retire, because we don't have to worry about inflation so much. But with the flexible, you take out 4% of whatever the portfolio was worth the end of the previous year. If the market goes up, you get 4% the following year of a higher number. If it goes down, you get 4% of a lower number. And here it is, the S&P 500 on a fixed basis. Again, you see all of these columns because it is replicating the fine-tuning tables, putting the fine-tuning tables to work. And we can see how bad it got with a 100% stock portfolio. You got down all the way to $718,000 from $1 million at the end of 1974. But if you had fixed income, you got down at 50-50. That's what my wife and I had. You got down to 956. It still wasn't pretty, but it wasn't 718. That's why we have fixed income in there, is to protect against those kind of periods. But I can look at the bottom, I can go out 30 years. The 50-50 ended up with 5.4 million. The 100% stock, 6.3 million. But you went through hell to get there. Here it is, if you made one small change, exactly the same investments, but instead of taking out 40,000, you take out 50,000. You run out of money. Now, you won't probably let yourself run out of money. You'll simply reduce your lifestyle. And instead of taking 50,000 plus, you'll be taking less. Maybe moving in with your kids. Then there's the flexible. As I say, we have over 100 tables to support you in this arena. And here we look, for example, this is the 5% a year. Remember, starting with 50,000, you ran out of money. Notice every column goes to the bottom. Why? Because there was an adjustment downward after a bad year, not an adjustment upward. Makes a difference. Lesson 13, I'm almost done. This is for young people. You want to do something special. You want to do something for 1 year of a kid's life, just one. I want you to do something that means you will be able to give that child for 1 year of their life $1 million. What I want you to do is I want you to put $365 into an account in small cap value, and I want you to hold that in your name until that child is earning some money, where you can take whatever that 365 is and you put it into a Roth IRA, and through that whole period you're in small cap value. And from that point, for the rest of that child's life, I want that money to be in small cap value. And if small cap value for 70 years compounds at 12%, that is over $1 million. Now, Daryl would say, but yeah, what after inflation? Okay, about 100,000. Now, just for 1 year, do something like that for them. And then, if you feel like it, The next year, you put in $365 for when they're 71, and then the next year for when they're 72. You get it? Now, by the way, a $3,000 upfront payment will get you a huge amount of money in terms of funding a Roth IRA to turn into tens of millions of dollars. I will be funding this for my new grandchild. Every one of my grandkids gets a little pot of money to grow for them for the future. But then I want to talk about this first 5 years of a Roth IRA. This could be for when that little kid grows up. But the bottom line is that if you are able to early in a child's life put away the $6,000, and in this particular case I'm going to tell you about, it's a real case. It just started in the last months. But I believe, as much as anything I believe about the future, that this young lady is going to do what she says she's going to do, because she's been working and earning money. And she's going to put away $6,000 a year into a Roth IRA. Now, she is getting some help from grandma and grandpa and mom and dad for college, okay? So they're actually very proud that she's doing this. She is going to put the $6,000 a year for 5 years. And then she's going to stop that Roth IRA. And she is going to let it go in small cap value. And if she does that, and she does it until she is 65, and then she takes out 4%, and she continues to own that small cap value, I mean, after the 5 years, she can go ahead and do whatever conservative things she wants. But I want her to own this package of companies. It's not like they're a bunch of losers. It's a bunch of bums. These are little companies that are all, you know, they are, let's say, $3 billion in size on average right now. So what I'm saying is that if this works and the 12% is achieved, she will have in that account $5.3 million at retirement. She will take withdrawals from age 65 to 95 of $22 million if she takes a 4% annual withdrawal, and she will have $46 million left over for her heirs. All right, your child cannot afford $6,000. If they could afford $600, you just simply divide it by 10. It's still a huge amount of money, and a great lesson with patience. And it's not unusual for people to believe in putting money aside and living it forever. People do that all the time in corporations that they like for the long term. I like this asset class for the long term. If it's too late for you to do it at 17, do it at 20, do it at 25, do it at 30. Daryl took it over all these periods, what you would have at the end, including the legacy amount from when you could get started. We have a lifetime investment calculator that I hope every one of you will give a shot. It is wonderful. It allows you to do all of these things I'm talking about, that I talked about today, except to do it with your own numbers. And there's one other thing it does that I just love. Let's say you thought the numbers I'm showing just don't seem reasonable for the future, but you like the idea that all the volatility is there, and yeah, life is probably going to be something like that. Or maybe I should start in 1973 and see how it works out, or 1990 and see how it works out. All of those things can be done, but it allows you to go in and say, take a 0.5% off of all the returns to the table. Take 1% off. Well, there you go. Make the assumption I want to hire an advisor and pay them 1%. Take 1% off the top and see how I'll do. This is all that stuff. As a matter of fact, Therese went through all of this in the introduction, so I'm not going to do anything except I want to mention one thing of what I think is great importance. It's the last one. We have a best advice link on our site. When you go there, and that's on our homepage, when you go there, you're going to see a drop down with a bunch of topics. These are topics I talked about today. I did not talk at any length, or in fact, I didn't talk about the portfolios, the recommendations that we make for investors and our best-in-class ETFs. I don't think I touched on that. But if you go to any of these links, you're going to get an article about the fine-tuning tables, you're going to get a podcast about the fine-tuning tables, and you're going to get the updated fine-tuning tables through the end of the previous year. Every year we go in and update all this work with a new podcast, with a new article, in the hopes that it will get you up to date in the work that we're doing. And what can you do for us? Easy. Share our information with others. Leave comments and kudos on social media. You all know how to do it, whether it's YouTube or a podcast. We need that help. And give us feedback. I am more than happy to find out that I'm happy when you tell me you like what we're doing, but I'm also happy when you tell me what you would like us to do more of. And we are a 501c3 foundation. And we do use the donations that are given to us. About a third of the money that we spend each year comes from outside donations. The other money comes from inside. And there's my email. I'm available. I'm not available to be an advisor. I'm available to answer generic questions, and most of the answers will go into a podcast or a newsletter or a video. And every once in a while, I pick up the phone and call somebody because I'm confused. So I appreciate it when you leave a phone number. Again, I do not give personal advice, but I know how to nudge. All right, Therese, thank you. I'm gonna stop sharing and open this up, if we might, for questions.
Okay. Thanks so much, Paul. Just having you go through all those tables is really helpful because it's a lot of information. I know they can all be found on your website, but it can be overwhelming. So I think it's helpful to go through that, especially for young investors, some really good information. I know that my two sons are actually on this Zoom call, so hopefully they're learning a lot.
Oh, right, that's great.
We do have a few questions that have come to me either through email or I've gotten some of them out of the chat. So I'm going to start. I'll just start with the first one here. I've been listening to Paul's podcast and I'm interested in his 4-fund approach to investing in equities. I currently have my Roth and Vanguard's Total Stock Market Index, VTSAX, for simplicity. My questions are: 1, does VTSAX approximate the 4-fund approach? And 2, which would have provided the best returns in his historical analysis?
Well, the total market index is going to give about the same return as the S&P 500. They've tracked it all the way back to 1928. And there is a 0.1% a year advantage to the S&P 500 in those long studies. So what that really says is, even though the total market index does give people some exposure to small cap value and to some large cap value and mid cap holdings that the S&P 500 does not, because these things are cap weighted and are driven by the growth part of the portfolio, that's not enough small cap value. That's not enough small cap blend. That's not enough large cap value to move the needle. So what happens is, by moving the needle and putting 25% each into each of those 4 asset classes, you move the needle over 1.5% a year in terms of return. Now that's from the past, and we don't know what we should expect out of the future. But the academics tell us that they expect there will be a small cap premium. They expect there will be a value premium. What they don't know is by how much. We know that for the period of 1928 to 2021, the average 40-year premium was 16%. return for a 16% for small cap value versus 11. That's a 5% difference. But over the last 40, 50 years, it's been about a 3% difference. So the return of the 4-fund strategy should be somewhere between 1 and 2% better rate of return than the total market index or the S&P 500, and at virtually no more risk. I mean, if you go back to that quilt chart that showed that the 4-fund kind of goes along the middle, and the green one, the S&P 500 or total market, is up at the edges, the top and the bottom, I'm thinking the 4-fund strategy is a lot less volatile 1 year at a time. 1 day at a time, that's a different matter. But 1 year, I would pick the 4-fund over that big S&P 500 or total market, either one of them.
Okay, thanks. We have a question from that was in the chat. Paul, do you know of any target date funds which incorporate the 4-fund concept in their equity portion? As much as I'd like to do it yourself investing equities to bonds as I age, I prefer the automated set it and forget it solution which target date funds provide.
Yeah, unfortunately, no, there is not. That is not available, and there's a good reason. And this came up in the conversation with John Bogle when I was there in 2017, because I've been very outspoken about the target date funds at Vanguard, because why would you put 10% of a portfolio of a 21-year-old in bonds? And all you have to do is look at those fine-tuning tables. Every 10% of equities or bonds is going to reduce your return by 0.5%. Well, we don't want to cost a 21-year-old 0.5% because of a 10% bond position. How much of a bear market is that going to protect? And should you even be protecting a 21-year-old against a bear market? You should be encouraging them to take advantage of the bear market. It's old people like me that don't want the bear market. So the fact is, and what Bogle said was, these have to be created to make them acceptable to all investors. So we have to do things that make it highly likely that they will stay the course. We want them to understand that bonds are a part of this portfolio over a long period of time, and we're going to start with just a little bit, and then we're going to grow from there. But that little bit is costing the investors. And they also don't want to load up on smaller value, because all of a sudden the portfolio is going to look different than the S&P 500 or the total market index. And anytime you start looking different than the index that people rely on, see on TV, hear on the radio, then they start saying, what's wrong with my portfolio? Why am I making less? Oh, it's that small cap value. What idiot put that small cap value in the portfolio? So what they do is they solve the problem. They don't expose the investor to what the investor really should have. And they understand that, by the way, but they're doing it for the sake of the investor, because they're trying to make it very easy for people to stay the course.
Okay, thank you. Krista, do you want to ask your question?
Yeah, absolutely. Thanks, Paul, for all of the great info. One thing
Nice to see you.
Yeah, thanks for having me. One thing that I wanted to circle back on was, how do you approach the international funds in like the 4-fund approach? Are you saying just stick in US, or where does international factor in?
Oh, no, that's a great question. I went to the US because I wanted to compare it to the S&P 500 and keep it US. That made it kind of work for me for today. No, I absolutely believe in international. We have the same portfolios built with 30% in the international equity portion and some in 50%. I happen to personally use 50%, but the difference between 50% international and 30% international is almost nothing. It's amazing how close they come over a long period of time. When you, and I didn't spend any time on this, so Chris Pedersen has done an analysis of the universe of ETFs. So in every asset class that we have, he has picked what he considers to be the best ETF in that asset class. He doesn't mean the one that's going to be the best performer in the next year. He wants to find the best small cap value that over the long term is likely to do better because it has the right amount of value, deeply discounted, it's the right size company inside of the fund, the expenses are low, the turnover is low. I mean, there are all these things that he looks at. The profitability of the companies are a consideration. So when you go to our website and you go to portfolios, you can drill down to ETFs, then you can drill down to best in class. And there you will see the recommendations that Chris has made. Now, he updates those periodically. So he will probably in the next year make a few changes, but he doesn't make them all the time, even if he found an ETF that he would like to, it's just too confusing if you move around very much. And by the way, tax inefficient if you're in a taxable account. But yes, as a matter of fact, you would see, let me just think about the worldwide 4-fund strategy has the same asset classes as the 4-fund US portfolio. Well, how can that be? Well, in the worldwide, the first fund is the S&P 500. That's large blend. The second fund is large cap value, but we use an international large cap value. That's the second fund. Then the third fund, small cap blend, is a international small cap blend, and then small cap value is US. So you still have the small cap value and the blend and the big value and blend big, but you have them balanced between US and international, and the returns come out almost the same. You can see it on that page that I included of how they did. So you can get almost the same return. The key is having the exposure to value, having the exposure to small, and we're doing all that we can to make it easy.
Thanks, Paul.
Oh, I should mention too, this is important. You can go to Vanguard and get all of these recommended ETFs commission free. Now you got to enter it online. You can't call up but if you do it online, whether you're at Fidelity or Vanguard, you can do it. You can do it commission free.
Okay, awesome.
And because we are at Bogleheads here, Chris has also made the recommendations with the corresponding Vanguard ETFs. If you are stuck emotionally on owning Vanguard, we're doing what we can to help you. But it's about a 1% lower compound rate of return than using the best in class.
Miriam, do you have a question?
Yes. Hi, Paul.
Hi.
Thank you for your presentation. It was very interesting.
Thank you.
I have a question about small cap value. The small cap value is a fund. They're funds made up of small companies, value companies. And what is it about those companies and small cap value funds? What is it about those companies that gives a premium? What do those companies do that gives the premium? And what happens when they are out of small cap value? When they grow too much and they're out of it?
Well, that small cap premium, according to the academics, is simply the premium for small over large. Small companies are more risky. So if they didn't pay a premium, then nobody would ever invest in small companies, because why would you take the risk? I mean, there is historically a higher rate of return, and it comes at higher volatility. So it's not a freebie. You're being paid for taking the risk of small. Value is another premium whether it's large value or small value. Value is defined by a number of ways, but according to the academics, the book value versus the market value. If the book market is relatively high, that's the book value, the net value, asset value of the company. If it's relatively high versus the market price, or if the PE ratio is low versus the market price, that would typically be value. Growth companies might sell for twice the PE ratio, twice the book to market. People are willing to pay a lot of money for those companies because they have an amazing future. That's the good news. But when growth companies fail, they fail miserably, and people can lose huge amounts of money. In fact, sometimes you've probably seen it after the close. A company comes out with disappointing earnings. They miss it by a penny, and the company drops by 25%. That's because people had huge hopes for that company. And you could look at companies like Amazon. People are counting on Amazon to become many, many times bigger than it is right now, because it's priced with the idea that there's going to be a return. Well, with value companies, people don't see that return, so they're not willing to pay much. And what the academics tell us, don't buy value companies one at a time. Because if you took 100 value companies that were out of favor, they're out of favor for some reason, selling for a low PE, selling for a high book to market. Out of 100, 5 years later, 50 of them are still dogs. The other 50 have done something special that turned those companies around, changed the view of investors, started making money when they weren't. And so it's the half that do that bring the premium up, because there's the other half that don't, that are still keeping the premium down. But overall, there has been a premium historically for taking the risk of investing in dogs. And when Warren Buffett, who's a value investor, it isn't that he won't get into a company that becomes a fast-growing company, but when he gets into it, it's typically when it's not a fast-growing company, when it sells for a fair price. And it's interesting because these small cap value, like the 17-year-old young lady who is going to put that money in small cap value, she probably won't know the name of any of those 500 to 1,000 companies. They're not household names. And at some point, you brought up the point, they're going to become growth. And they're going to move out of the value portfolio into a portfolio that is some other index.
So could you define value for us who?
It could be a low price to earnings ratio. It could have to do with cash flow per share. It could have to do with the book value versus the market. There are many ways that professionals identify value. From my viewpoint, when we recommend an Avantis fund, and we recommend several of their funds, they are probably, this is one of the finest fund families for what we're looking for the people who follow our work. We know what step by step what they do, and how they buy and how they sell, and at least as much as they're willing to share that isn't truly proprietary. So at that point, we say, obviously, you do it. Dimensional funds may do it different from Avantis. And there are other small cap value funds. Vanguard. I mean, if you read Chris Pedersen's article about how he chooses ETFs that fill each one of these brackets, he explains what he's looking for. But for example, at Vanguard, I think it's VBR, the average size company is about $6 billion, as opposed to the fund that we use, that we recommend, is about $3 billion. It's smaller. It's more deeply discounted. And so, and they overlay the size and the value with a profitability factor. That's something else that might be there. Now, are we expecting the people who follow our work to become experts on factor investing? Probably not. But if they read Larry Swedroe, they can kind of become one. He does a great job of digging in to the ETFs. And what we're hoping, when I say that I'm trying to turn the do-it-yourself investor to help them have the same knowledge an advisor has, an advisor needs to understand the risk and the return. They need to be prepared for all the things that naturally happen in a portfolio where the individual investor says, what the hell is going on here? I don't understand. Well, you should understand, because you should have seen the past gains and losses and notice that things for different reasons go down, but they seem to go down very similarly. And that's the part of investing that we can know the history. Nobody, professional or amateur, can know the future. Nobody. And anybody who talks like they know the future is just blowing smoke. It is nothing more than telling people what they think you want to hear as an investor so they can sell you something.
Thank you.
You're welcome. Thank you, Miriam.
Okay, we have another question from the chat. Is there an advantage to a 4-fund strategy if you're retired and maybe have a 15-year horizon?
Ah, funny he should mention 15. I'm 78. I'm thinking in terms of a 15-year horizon. Well, I'll tell you what I know. I know that if I look at that table that I used early on, and I looked at 15-year periods, and there were ranges of what the good times look like and the bad times look like. And so I have to ask myself, when I look at some of the money that's in our portfolio, are we investing for ourselves, or are we investing for children and charities? And in large part, we're okay if we just sat on fixed income. If we just took the half of the money that's in fixed income and put it aside, we could live on that. The other money is really for others. And so I look at the 15-year numbers in that table that showed the S&P 500 and shows the 4-fund strategy. It was that first, the equity returns from 1928 to 2021. What you'll see is the 4-fund strategy had virtually the same worst 15 years as the S&P 500, but the returns were better in the good times. So yes, I would, if I had 15 years, take the risk with money I don't need to live on. But if they decided they want to put the S&P 500 in, when you go back to that